Calendar spread versus diagonal spread. If you are curious about the differences between a calendar spread and a diagonal spread in options trading, you are in the right spot. Let's break down these two strategies to see how they work and when to use them. First, a calendar spread involves buying a longer-dated option and selling a shorter-dated option with the same strike price. This is often called a horizontal or time spread. Both options can be either calls or puts, but they must have identical strike prices and different expiration dates. The goal here is to profit from time decay and changes in implied volatility. On the other hand, a diagonal spread also involves buying a longer-dated option and selling a shorter-dated option. However, the key difference is that the two options have different strike prices and different expiration dates. This strategy combines elements of both calendar spreads and vertical spreads, allowing for more flexibility. Now, let's talk about market outlook. A calendar spread is typically used when a trader expects the underlying stock to remain relatively stable until the near-term option expires. The trader profits mainly from time decay, especially if the near-term option is overpriced. In contrast, a diagonal spread has a directional bias. This means the trader expects the underlying stock to move in a specific direction before the near-term option expires. The different strike prices in a diagonal spread allow the trader to benefit from price movement in addition to time decay. When it comes to risk and profit potential, calendar spreads generally have lower risk and limited profit potential. Profit is maximized if the underlying price stays near the strike price at the near-term expiration. This allows the short option to expire worthless while retaining value in the longer option. Diagonal spreads carry moderately higher risk but also offer higher profit potential if the market moves favorably. The differing strikes enable the trader to benefit from directional moves in the underlying asset, capturing gains beyond just time decay. In terms of cost and complexity, calendar spreads are usually cheaper to enter. Since both options share the same strike price, they are simpler to manage. Diagonal spreads, however, tend to be more expensive and complex due to the different strike prices and expirations. When considering market conditions, calendar spreads work best in low volatility or neutral markets. They are effective for traders looking to capitalize on time decay and volatility contraction without expecting large price swings. On the flip side, diagonal spreads are more suitable for moderate to high volatility environments. They allow traders to combine premium collection with directional exposure. For example, a trader who is bullish on a stock might buy a longer-term call at a lower strike and sell a shorter-term call at a higher strike. This strategy profits if the stock moves upward while collecting premium from the short call. To sum it up, the key difference between these two strategies lies in strike price selection and market outlook. Calendar spreads use the same strike price and focus on time decay, while diagonal spreads use different strike prices, adding a directional component and potentially higher returns at increased risk. Both strategies involve managing options with different expiration dates but serve distinct purposes in options trading.